Welcome to Navigating Equity Compensation, a webinar series hosted by Countsy. Today's topic is Global Shifts in Equity Compensation. Our guest today is Don Tobias Joel, a partner in tax, compensation, and benefits at Baker McKenzie in Amsterdam, and Kelly Nider, growth lead of equity outsourcing at Countsy. And Kareen Schneider, founding partner at Compass Strategic Advisors, is today's moderator. We hope you enjoy this conversation. Now let's get started. Hey, Kelly, how are you?
I'm good. How are you?
Good. Well, welcome everybody. You may notice that we don't have a nice picture of Don Tobias Joel on the screen. We are having technical difficulties with our guest in Amsterdam, not because he's in another country or continent, but we're trying to work those things out. So I thought we'd just get started because we want to be respectful of people's time. And Kelly, you and I have been in this business for a long time. So international stock plans, certainly something we've worked with a lot. And maybe we can just have a conversation for a bit and see if we can get Don Tobias on. If not, what I think we can do, maybe Kelly, if you're open to this, is we can email everybody. There he is. Woo, right on time. It doesn't get better than that. Hi, Don Tobias. Good morning or good afternoon. We're just getting started. So why don't we do introductions and then we'll jump into things. Really happy to have both of you on. Two people I've known a very, very long time. Kelly Nider, who, as we said, is the growth lead at Countsy. And Kelly, you want to just do a quick introduction?
Sure. Hello, everybody. My name is Kelly Nider. I'm the equity growth lead at Countsy. We provide equity outsourcing services to both public and private companies. As Kareen mentioned, I've been in the equity space for almost 30 years and excited to talk about this topic today.
Great. And Don Tobias, thanks for joining us. Can you just do a quick introduction?
Hello, everybody. My name is Don Tobias Joel. I am a partner at Baker McKenzie, the international law firm based in Amsterdam. And we focus on basically the taxation of employment income. So anything to do with whatever goes in and out of your wallet, that's basically what we advise on. And within that framework, we typically focus on what we call the 3 E's. So that's executive compensation, expatriate compensation, so people who are assigned from one place to the other, and of course equity-based compensation, the 3rd E. And I think this is a lovely. This seminar is a lovely way to to bring all these 3 items together in a relatively short period of time. So happy to be here, folks. I had a little bit of trouble dialing in. As you can see mostly the lower part of my face. And that's because I'm working from my iPhone at the moment, which is on a standard. It's a little bit too low for me, but I hope you'll be able to get through this right.
No, actually, we can see all of you and we can see your hands. So if you want to sit back a little bit, feel free.
This is the only setup I can manage at this time.
Yeah, no, I mean, if you sit back a little from the camera, that'd be probably good because you're very close to the camera.
Yeah.
Okay. So this is a topic. First of all, I'm going to give a little plug for Baker McKenzie. Don Tobias doesn't know I'm going to do this, but when I first started in stock plans at Oracle, I very early on, we were granting stock options to everybody around the world. And there weren't, and I'm talking about the mid 80s, there were not a lot of places to find the rules. You just, you really kind of granted the stock option, you gave it to the employee, you just kind of hoped for the best. We used US style taxation, in terms of collecting the tax and thinking about how people were filing their tax returns. And the Netherlands was one of the first countries where we got educated that it wasn't necessarily the same as the United States. And I'm very thankful to Baker McKenzie, who I met Ed Burmeister back then. And Ed was one of the first people to evangelize and walk around and say, hey, you need to understand how each country works and that not every country in the world is filing their taxes on April 15th like we do in the United States. So it was a very early wake-up call for me that if you're going to be working in this business, you really need to understand, first of all, just not just, as you said, the 3 E's, Don Tobias, but there's a cultural difference. There's a, there's a time zone difference. There's a banking difference. I mean, there's so many things that are different, and there's an underlying understanding of these plans that are so different. So, so there's a lot. I think you guys have a very interesting job, and I know you have to cover almost every country in the world. So I promise you, we will not quiz you on all these obscure little tax laws in Mauritius or something. something. But let's start talking, because there's a number of countries we want to talk about today that have some updates for people, and I think that's why people are tuning in, is really to hear, you know, what's new and what's different. I want to just start at a high level, Don Tobias. What are the most common mistakes that you see most of your clients making, regardless if they're American clients or not? But what are the most common mistakes?
Well, I think there's two really. There's two basic things to keep in mind. Do you want to call it mistakes or progress areas? I think the first one is to keep track of your employees, right? I think once you have all your employees neatly in one jurisdiction, it's actually quite easy to comply with all the rules and regulations. If your processes are set up for one country and everybody is quite familiar with what they need to do, then it will probably run smoothly. But when it becomes more difficult is when employees start moving about the globe. Like I said in the beginning, when you're talking about these expats, right? And you've seen, for instance, in the COVID pandemic, when a lot of people had to work from home or wanted to work from home, and they said, you know what, I have a house in the Caribbean, or I have a house on Bali, or anywhere where the sun shines. And their manager would say, well, you have to work from home. Doesn't matter, work from home in any other location. But suddenly, when you're there for quite a substantial amount of time, you incur some tax filing obligations, some labor law obligations, migration laws might kick in at some point. So keeping track of your employees is really key to make sure you don't run afoul of the law. And now we're talking about COVID, but of course, COVID pandemic is gone now, but you can still see people who are just simply assigned. If you're a startup or a scale-up, and your employees start moving to the first location where you're expanding, let's say you're in the Netherlands and you're expanding into Belgium, already that's a huge difference. Stock option laws between the Netherlands and Belgium are notoriously different. So these are things that can come up rather surprisingly, and suddenly can create a lot of difficulty for a company keeping compliant. So we had keeping tracks of employees. And the second thing is keeping track of the law. Obviously, the law is a very multifaceted thing. And new jurisdiction, new jurisprudence, new case law can come up, at the flip of a hat, really. So whatever was compliant a month ago might be completely different just because the Supreme Court in some crazy jurisdiction came up with a weird statement somehow. And then suddenly your plan might have to be revised to make sure it still complies with the new laws. So it's keeping track of your employees, keeping track of the law. That's basically the key points where you need to be very mindful, because that can have a real impact on your compliance status.
Yeah. And so, Kelly, I know you work with a lot of kind of small to mid-sized companies, both private and public. And they don't always have a staff of 6 people who are doing this. I know some of these really large companies, they might have one person just dedicated to international, but I think a lot of your clients don't have that luxury. So what would you recommend for them as Don's talking about this? One is keeping track of your employees. That's obviously an HR function. But what would you say in terms of keeping track of the law? Are there some tips and hints you can give those people?
Yeah, I think the first thing to recognize that it needs to be taken seriously. A lot of times I'll talk to companies and they're like, oh, I have some employees in this country or over there, and it's kind of just pushed aside. You can't do that. This is not something that all because it's not familiar to you, you kind of hide or shy away from it. So I'd say first thing I'd recommend is you have to embrace this heads on, because it's very, very important. And even a small handful of people can really have detrimental effects if it's not done correctly. So one of the things I say is try to keep up with the changes, right? There's a lot of resources out there that are free that you can sign up for newsletters. I know Baker McKenzie I have a link, I'll throw it in the chat. It's a free metrics on international employees. So I'll throw that in there when Tobias is chatting. But there's the GEO, there's the NASBP. You can sign up for free newsletters. And this is not something that's a one and done change. This stuff changes all the time. So you have to embrace it. You have to educate yourself. And there are resources out there to, attend webinars or to get newsletters. And if that, is not enough, then it's okay to ask for help. It's okay to ask to reach out to these firms that specialize in this, say, I need some help on this, all because you have 3 people that may not be in the US, you really have to be knowledgeable, because it's very tricky and it changes all the time.
Yeah. Well, and the other thing I tell people is you need to talk to your executives and your board, because they really don't understand this. And they might have a philosophy of everybody gets a stock option or everyone gets an RSU. I always tell the story of Uber, who was granting RSUs to everybody. And in Australia, if you received an RSU, you automatically owned the tax, even if you weren't vested at this time. and all the drivers were like, I have to quit Uber because there's nothing, I can't, not take the RSU. Well, that was at the highest level. That was the philosophy of, we are a company where everyone gets ownership. And I think sometimes that conversation needs to happen, so that you may say, well, in this particular country, we may not want to grant that type of an instrument, or we may want to look at cash or something else. So I'm sure, Don Tobias, you have those conversations with a lot of your clients where you may say, this is just not the country for you.
Yeah, not the country or not the population, like you were saying. We had a large supermarket in the Netherlands, one of the biggest in Europe, at least at the moment, who tried to grant stock options to the cash register employees. And that also, especially because of the laws at that time, this was in the late 90s, made them have to pay taxes up front, which they really didn't have. So it's indeed the type of cash, the type of remuneration, and the type of people who will get it.
Yeah, yeah. Well, if you don't mind, Don Tobias, maybe we can go through a few countries and give us I picked these because, one, I think there's a lot of American companies who have employees in these countries. And secondly, I think there's something for you to tell us that's maybe new that people should be aware of, or relatively new. But let's start with France. Always an interesting challenge since I've been in stock plans. What's new in France that we should be aware of?
Right. Well, I think for all of these countries, you can make a distinction between what's new laws and what's new jurisprudence. Yes, I'll give you a couple of samples of both of these items as we go through the list. But for France, I think a main thing that is now quite new is the new law for management packages. Right. This is private equity type of laws. And this is by now rather famous Article 93 or 93 in French. Of the French Finance Bill. And this introduces a new tax and social security regime for management packages. It will be applicable to net gains from the sale of securities acquired or subscribed by employees or managers, in case such gains are acquired in consideration of their duties. Now, normally, capital gains from the sale of securities are taxable according to a 30 to 34% flat rate. But under the new regime, these net gains are now taxed as regular employment income, and therefore subject to the progressive French income tax rates. A portion of the net gain that is lower than a financial company performance multiple remains eligible for the regular capital gains tax regime, which is the flat tax that I was talking about before, 30 to 34%, under certain conditions. And the ceiling is applicable to qualify for the capital gain taxation, which is calculated based on a very specific formula. Now, this new regime applies to a wide variety of securities, which include those from regulated schemes under the French law, which is the French qualified awards, such as French qualified RSUs, stock options, and BSPCs, but also to non-regulated schemes, non-qualified awards, ordinary shares, preferred shares, and warrants, etc. So this is a new thing. I think it's also part of a trend over Europe, where more and more countries are implementing these new tax rules for, let's say, private equity type of transactions. And France is now one of the jurisdictions that has joined this whole thing and has included some of the new legislations as well.
So can you explain what a management employee would be? Is there a definition of that, or is that just you'll know when you see one?
Yeah, I think what you would typically try to identify is people who are in usually the upper management layer of a company that is the target, right? So a private equity fund trying to acquire a target will typically seek to keep the top end employees, right? These are the ones that drive the growth. These are the ones that typically get the management packages. They say, you know what, you have to have some skin in the game. You have to invest into the future benefit of this company. And therefore, we give to you a typical management package, which has a hockey stick, right? So you invest a little, you get a lot at the end. So that's the type of management packages that we are looking at when we're talking about this type of regulations.
Okay. And just to be clear, there's nothing you can do about this, right? This is just the tax, and there's no fancy design or anything else that you could do to protect
I think
executive.
As always, when you're applying the law, it depends on the facts and circumstances, right? Yeah. So first of all, the good news is you can always call your lawyer, who will have a very good look at the plan and see, well, does this particular law actually apply to this particular plan? Yeah, and then you make a decision based on whatever you find in the plan. Is this indeed a plan that fits this description? Or is there argument? Is it possible to have an argument about it? Or does it really not apply at all? And in case there is an argument, that's when it becomes really interesting. You try to strengthen your position. But once you are in the scheme, then you have to pay the taxes.
Yeah. And I think if memory serves me right, that progressive tax can go as high as 65%. Is that right?
yeah, France is a notoriously high tax rate jurisdiction. So indeed, when you are exchanging the capital gains regime for progressive income tax rates, that can be detrimental. That's not as great as as the alternative. So there's clearly there's a reason why people want to make very sure if not they are applied to this regime.
Right. Okay, let's go to another country nearby, Germany. What's the latest in Germany?
All right. So for Germany, there has been some clarity provided by the Federal Tax Court, and this applies to, interestingly, a situation that was also part of a recent discussion in the Netherlands, which is what happens if an owner of a mid-size or smaller company wants to ensure the continuity of his enterprise, and then basically transfer shares to senior employees as a gift. The question then is this gift? Is it employment because they are actually employees, or is it instead a gift? So maybe taxable with gift tax, for instance. And in the old days, before this new court's decision was published, the typical thinking in Germany and as well in the Netherlands was that it would probably be taxable as taxable wages. Now in the new decision, it says, well, it really depends on, again, facts and circumstances. If there really is, for instance, if there is an obligation on the part of the employee to transfer these shares later on to whoever is going to be the next successor, so he doesn't get free ownership, but there's a pledge to it that you can't, you have to keep them for the next person, then there might be a reason to say, oh, this is not taxable wages. This is in fact, a typical gift that could be taxed with inheritance tax or gift tax, which can be more beneficial depending again on the amount that's involved. But generally, the tax on employment income is higher than the gift taxes in most jurisdictions. So that can be an interesting way to ensure both the continuity of the company and to make sure that this is not taxed too much. So it was an interesting decision by the German courts.
Got it. Okay. Next one is a country that a lot of U.S. companies have employees, and I think, Kelly, probably a lot of your clients do, which is Israel. What is going on there?
So in Israel, there was an update provided recently that indicates how tax and reporting apply when an employee sells shares that were granted to them in the capacity of employee. Now, the employee's income from such shares can be classified in one of two ways. So first as a regular income, or secondary as capital gains, taxed at the rate of 25%. Now, when an employee receives payments in addition to their regular monthly salary, it's important to determine whether this income should be either taxed as regular income or as capital gains under this new update, right? So it's definitely made a difference again, quite similar to the case we were talking about before in Germany. Hey, is this now income or is it capital gains? Because the difference is obviously in the higher tax rate. The same update also specifies how employer or the trustee in some cases has to withhold tax at source and report the sale of these shares. At the time the shares are sold, so this is the moment of realization, an additional passive capital gains tax applies to the portion of the income classified as capital gains in the trustee track. However, this additional capital gains tax does not apply to the portion of the income classified as employment income. And because the employment income falls under the ordinary income tax part. So companies in Israel, this is the takeaway, I think, need to have a robust tracking system in place as of this change. And employees have to understand the tax impact of equity incentive at realization. Does it either qualify as capital gains or as employment income? I think this is important for anybody in Israel who has been granted this type of compensation, because it can really make a difference again in the applicable tax rate.
Right. So in Israel, you need to ensure that your employees are part of a what is it, Section 102 trust, right? You have to set up the trust there, make sure that the options are held by the trust, that they're exercised within the trust. And then I guess even if that happens, you still could have a possibility that a portion of the income is capital gain. And I guess, is that, I don't know if you know, but is it due to holding period that it would determine it's a capital gain? Or is it once you leave the company, you no longer work for them, it becomes capital gain?
Yeah, the way I get it from my Israeli colleagues is that it's really, again, there's multiple things that you have to look at. It becomes quite technical really soon. So that would definitely be something to look at when you have the plan in hand. See, okay, what are the abstract reasons where you can pigeonhole the compensation to be either capital gains or employment income. That's something to really look at when you have all the plan documentation with you.
Yeah. And I think, Kelly, and I'm guessing get on your clients, but I bet a lot of your clients have Israeli employees who are going back and forth between the US and Israel. Or what I see very commonly happen is three guys in Israel start a company, and one of them decides that he's going to or she's going to move to the United States and set up an office in Silicon Valley. And they're still Israeli citizens, but they're going back and forth. And so I'm assuming you see that quite a bit with any of the companies that are related to Israel. Does that sound right?
Yeah, there's definitely a lot of mobility in play with a lot of these companies. Yes.
Yeah. So, Don Tobias, just to bring in one of your other E's, in that situation, what do you think a company should do? Especially, what I see is that they're putting people into the United States for like a year. It's not. I'm going to come for a week and kind of bop around, see who I can meet. It's I'm going to move. I'm going to get an apartment. I'm going to go live in the United States, even though I'm an Israeli person and I have every intention at some point to go back. But I'm doing this for the company. So, any words of advice on situations like that?
Yeah, definitely. I think if you look at what we have in the world of taxation is tax treaties, right? Typically, most countries will have a tax treaty, especially the more developed countries, which basically regulates what country has the right to tax. And the key component is always, where are you a resident? And in the situation you just described, the example, yeah, it really depends. Okay, if you are a single person, you're relatively young, because mostly it's the young folks who go on an assignment. You might have a house in in Israel. You might rent a house in the US, and you might not have a relationship, just have no children yet. And it's very hard to pinpoint where you are a resident. Typically, residency is measured by, okay, where's your socioeconomic center? That could be any place. So the real key item here is to see, okay, typically if you're a resident, you are taxed on your worldwide income, right? So if you're a resident of Israel, then basically you just list all of your income in your income tax return and then get a relief for double taxation for anything that the tax treaty allocates to, in this case, the US. And then in the US, you only tax at source. So that's not so bad. Typically, you can even have a little bit of a tax advantage. If the income tax at source is lower than what you would pay if your entire income is taxable in, let's say, Israel, then you have a bit of a tax advantage. This is the gimmick of the salary split, right? Split your salary across multiple jurisdictions and reduce your overall tax rate. But then again, if some tax authorities say, you know what, according to our local laws, you are now a resident of the US and we seek to tax your entire income, then you get into a bit of a pickle, because maybe the Israeli tax authorities have the same opinion, and then both countries see you as a full resident taxpayer, and who then provides the relief for double taxation. So this is the key item that you always see in cross-border employment situations. The residency determines which country has to, give up a relatively large amount of their income tax powers. So it becomes a contentious issue.
Yeah. So how often, I don't know if either of you know the answer to this, but how often do you see let's say you're working for a larger company, you're asked to go move to another country. How often is your employer paying for tax advice for you? Or are they generally going, you know what, that's your problem, not going to get involved? What do you see as general practice there?
Well, I think this is, especially in the European countries, this is almost mandatory under employment law. You have to be what is called a good employer. So if you're asking your employee to undertake, a trip to a different country for a longer period of time, and or you probably would have to know that there's going to be tax consequences, then it's almost always upon, the burden is upon the employer to ensure the employee, undertakes this whole thing in a properly informed manner. So yes, I mean, obviously for us as lawyers, that's good news, because that means there's a lot of job security here.
Yeah.
But I do believe that, if you're an employee and you're really going to work really hard in a different jurisdiction, you have all these things coming at you, you should not be confused by new tax laws. You shouldn't be worrying about, okay, am I actually going to lose a lot of my benefit because the taxes are higher or different than in my home country? So I think, even if the employment rules do not mandatorily enforce professional advice, be a nice employer and make sure that your employee has all the focus that he needs to have on the case at hand and doesn't get distracted by all of the other laws. Yeah.
Well, it's a benefit too, right? That's the whole point. You're giving these awards is a benefit. It could be to hire, to retain. So, it should be treated as so, right? You don't want it to be looked upon negatively by the employee receiving these awards. So you kind of step back and ask yourself, why are you doing this as a company? So just still make this a good thing for everybody. Don't make it something that's hard to understand, or they're worried about their taxes, because then you lose the whole point of those awards too.
Yeah. Good point. Okay, let's move to the UK, another country where a lot of Americans have employees in the UK. And I just want to remind everybody Ireland is not part of the UK. So the UK is England, Wales, Northern Ireland, and Scotland. So, because sometimes people don't understand all the geography, but what's new in the UK, which, by the way, is a country that seems to love ownership?
Definitely, and I think one of the key new initiatives, and I know that you are also quite fond of it, is PISES, right? This is the
Yeah.
Private Intermittent Securities and Capital Exchange System. I like the acronym better. So yeah, it's PISES, and that basically is the UK's private markets initiative. And the London Stock Exchange, new private security markets, just received PISES approval notice by the Financial Conduct Authority, the FCA in the UK. So that's actually quite nice. That means that according to this update, the London Stock Exchange has become the first operator to be granted a PISES approval notice by the FCA for its private security market. And this new secondary market will provide private companies with access to intermittent liquidity auctions that leverage the LSE's public markets infrastructure. That means PISES will expand the options available to private companies and their shareholders, including employees. From a legal point of view, that means that amendments to existing EMI and CSOP options may be made to include PISES as an exercise trigger under employee share schemes. But this again is just like with the Israeli legislation we talked about before, provided certain additional requirements are met. But in principle, I think it's a good thing. I think it's also something that I hope will have a lot more followers in other EU jurisdictions, because it really is a great improvement for private companies to have a liquidity market where there used to be none in the past. So PISES, I like it, and I think it's great that it's moving forward in the UK. Definitely puts a lot of companies in a market where they could not operate before.
Yeah, yeah. So that's great for private companies who are based in the UK. I would say I did hear that Forge Global, which is one of the private market brokerage firms, that they've been approved to be on PISES now. Forge has now been acquired by Schwab, and we should see that closing, I think, next month. But I think for Americans who are working for UK companies that are privately held, this is a really big move forward in terms of getting that liquidity and having more structure and having more of a market. I know in the US we talk about the private market, but it's a very unstructured, very informal thing, compared to our capital markets. And now on the private side, I am excited to see what the UK does with this. And again, it's a government, I think, that's very supportive of helping people who own something in their company, be able to benefit from that.
Absolutely, yeah, and I think again they are at the forefront of this, and I am sure that in the in the EU, and I think also in the US, there's a lot of people looking with great interest in seeing if they can copy something similar.
Yeah, good. Italy, what's going on in Italy? Always see, I used to have a huge client in Italy, and oh my God, it was so difficult to figure out what the laws were there.
Italy is always an interesting jurisdiction, that's for sure. And there's many things to talk about, but one thing I'd like to mention is that a tax rule was recently published that concerned a company granting shares to its shareholders without requiring any payment or contribution in return, right? So they granted it without a need to do any payment. And the ruling emphasizes that the absence of an actual monetary outlay by the managers excludes the existence of an actual investment risk. So this is an essential condition for qualifying the management's participation as a financial investment. So in this case at hand, the managers did not contribute any capital and therefore did not bear any real investment risk. This condition could not be deemed satisfied merely because the managers also held ordinary or special shares. And the reason for that was that those instruments have distinct remuneration mechanisms. Moreover, the return on such financial instruments was not granted to other managers in the same positions who held shares without having been allocated the instruments subject to this tax ruling. Now, as a result, the income from these financial instruments was considered as employment income without the possibility to qualify for the favorable Italian carried interest regime. So that's one of the things that, again, I think this is quite interesting. A lot of the changes that we see in the European Union are around these carried interest type of structures. I mentioned France in the past. The Netherlands was one of the first countries, I think, in Europe, in continental Europe, who introduced new laws on this thing. And we see, more and more countries coming together and kind of copying each other's laws a little bit, where they say, you know what, we cannot have typical investment managers or managers at the private equity funds having their shares just in the capital gains regime. We need to levy more taxes on it. So therefore, we're going to try and figure out or carve out really situations where these investments are not actually investments, they're just part of compensation. And here in Italy, you see them doing the same thing as in France, making sure, basically also that there's a higher tax revenue, because all the countries are looking for cash.
Yeah. Well, I'm going to put you on the spot here because I didn't have it on our list, but the Netherlands has a new prime minister as of, was it
Definitely.
yesterday or the day before?
I think it was his first working day.
Yeah. And anything you think, I mean, I don't know, much about the politics, but do you think is employee ownership going to be important to this regime, or do you see any potential changes?
Yeah, I think one of the major issues that has been subject to scrutiny, I think not only in the Netherlands but abroad as well, is the new taxation on wealth. It is the infamous Box 3 tax. Google it and you will find a gazillion hits in Google, because it's been a nightmare for the last 10 years or so. Now, the old regime used to work as follows. Basically, at the beginning of the year, they measured all of your wealth. And if you were above a certain threshold, they said, you know what, this wealth will probably yield 4% per year. And the 4%, we will tax it at 30%. So effectively, the tax was 1.2% on your wealth. Not on any capital gains. There was no capital gain tax in the Netherlands. There was just a capital wealth tax, or a yield tax, whatever you want to call it. Now, this worked quite well up until about 10 years ago when we had the financial crisis. And, people typically become subject to this Box 3 tax when they have a little savings involved, not so much when they have shares of this. So most of the people covered by it have significant savings. And the savings, of course, never reached a 4% interest rate, right? It used to drop down to 1%. At one point, it was negative. So then there was court case upon court case before the Dutch Supreme Court. And after 3 or 4 different court cases, the Supreme Court got fed up with the government and said, you know what, we are just going to cancel this whole thing. You have to tax the real return on investment of these of these holdings that people have. So that means shares, just money on a bank account, your secondary house, all sorts of wealth, your Rembrandts that you have lying around the house, all of it. And then people, of course, there go your Rembrandt. Yeah.
I know.
And this is something that people said, okay, but again, they would lodge, objections all the way up to the Supreme Court and say, well, I'm not making my 4%, it's lower. And of course, when it was higher, they remained still. And then ultimately, the government said, we are going to now introduce the real rate of return on your holdings. That's going to be the new taxable base. But they made it again so complicated that just lawsuit after lawsuit occurred, and now I think a couple of weeks ago they introduced a new rule that said, okay, you know what, we are going to tax the actual increase in value of your shares and your basically your cash holdings. And for shares, this is quite a contentious issue on the Dutch tax law, because that means, let's say you're in a non-listed company, you have shares and you cannot even sell them, but they have increased in value. The company has now has gotten better. The value goes up, and then basically, okay, the new rules say, your increase has been 10%, so we're going to tax an X amount on the 10%. But you have maybe no other cash lying around, especially if you're in a startup, for instance. You have no other cash lying around to pay the tax man. And now they're trying to work out certain, let's say, they're carving out the startups now. This is a proposed legislation, but in general, all of the Dutch fiscal world has gone crazy when this proposal was lodged. This was lodged by the previous government, which is now just stepped down yesterday. And the thing is, just today, news came out that the new government will reconsider this whole new law. So the new law that says, okay, we're going to take the real increase in value and we're going to tax it, at rather significant rates, a little bit higher than they used to be before. And they're going to take more time to think about it. But this has been truly a nightmare that has been going on for about 10 years. Every government that has stepped in since then has tried to figure out a way to tax somehow the return on investments. And it's confounded by the fact that the Dutch tax authorities are struggling with ancient IT infrastructure. They are running on Microsoft's version 1991. And it's basically gone to the point that they say, look, we cannot implement any significant tax changes because the systems won't work if we do. So definitely no final answer on how Box 3 will look in the coming years. But anybody who is advising their employees to hold shares, and this is after the taxable moment as employment income, right? Then they become part of your wealth. So you've gotten your options, they're taxed as employment income, they become part of your shareholdings. At that point, just Google the heck out of it, because it can change tomorrow and it can change the month after that again. It's talking about job security. This will keep Dutch tax lawyers busy until the next. I'm sure.
Yeah. Well, and a lot of American companies work with Dutch employees. I have a nephew over there, works for a startup, and probably doesn't have a clue about any of this, and can barely afford a cup of coffee every day. But on paper, he's worth a lot. So I can see where that's a problem. And I do think, the American style of taxation, which is you pay when you receive the income, when you actually make it, although there's a lot of debate here now about something called a billionaire tax, which is something that we're undergoing. Google that one. Especially in the state of California, that there's a real big question about when should you pay tax? Is it when you finally see the money, or is it when you are sitting on it, basically like a chicken on an egg? So wow.
But that's the thing that a lot of these tax authorities are struggling with, right? As long as you don't sell the shares under a capital gains type of treatment, then the tax authorities can wait for ages until they get some money out of it. And I think that's what they're trying to avoid, but it's hard to do. It's really hard to do.
Yeah. Well, the issue with the billionaire tax, and again, this is a little bit of Elon Musk, is that he never sold any of his shares to buy Twitter. He borrowed against the shares. So he never saw any income, and yet he was able to use his wealth to do something else. And so a lot of people are saying, oh, this is not right. And so yesterday when I went into my grocery store, there was a guy in front asking me to sign, a petition to get something on the ballot in California. And we had a long talk about, how they had written this billionaire tax. And one of the things it included was all the retirement plans. And so that was what everyone was up in arms on. If you're sitting on, let's say, $1 million in your retirement plan, you'd have to pay tax on that, even though you hadn't taken that money out of your retirement plan yet. And so everyone said, well, that's not fair to these billionaires. And I'm thinking, I don't think they're worried about their, $1 million in their retirement plan. I think they probably don't even know they have a retirement plan. So anyways, it just shows you how complex and human this all is. If you really think about this, the politics and the beliefs in these different countries. And I think you've said a few times now, Don Tobias, you've mentioned private equity. And I think that's the other thing, Kelly, is that, a lot of companies for most of our careers, you would just work for a corporation and it was owned by its shareholders. And more we're seeing these companies are being owned by private equity and that the plans are designed differently. So I think this is another thing for your clients to remember that, depending upon how your ownership is of your own company, you need to ensure that you talk to your legal and tax advisors and make sure they understand who actually owns your company, not just who we're renting a stock option.
Yeah, no, I agree.
Yeah. Well, this has been great. And I know we're coming up to the end of the time. Kelly, I wanted to ask you one last question, which is, in terms of educating employees, what kind of advice do you at Countsy give your clients?
I think first and foremost, as a plan administrator, and I'll talk louder, which isn't an issue because I'm pretty loud anyway, get educated, use resources to know what you're talking about, but then educate your folks, right? So you can do that a lot of different ways. There's lunch and learns, there's webinars. I tend to see one-pagers, keep it simple, right? Here's a one-pager, here's a snapshot. I know this sounds silly, but use images, right? People like to-dos and checklists and pictures and stuff like that. Just keep it simple, but don't not communicate, because don't assume people understand, because they probably don't. So again, webinars, lunch and learns, FAQs are awesome. If you have a software provider you use, they probably have an employee portal. Use it. Encourage people to use it. You can put FAQs out there. You can put videos out there. So if you're using software, you probably have a resource. We work with our clients with that too. We'll say, well, let's put something out on the website for the employees. Let's put an FAQ. Let's get something together. It's very simple. ChatGPT is a wonderful thing, and you can make something very quick and put it out on that site. We help our clients do that, but you can do a one-pager, which goes a long way.
Okay. Yeah, and something else I'd add, obviously give a plug for Baker McKenzie. I'm sure, your tax advising company could put together some tax papers, they're very high level, but maybe if you're, let's say, in 7 different countries, they would provide the tax guide for these 7 different countries. One of the things I always hated is when I ran stock plans was to say to people, well, get your own tax advisor. And I can't tell you how many times people are like, I don't know where to find a tax advisor. So maybe have a list of tax advisors, maybe some local or, so that your person has a place to start if they do have to pay for their own tax advice. And then I'd also just do a plug for Bruce Brumberg's, mystockoptions.com, I think is something that a company could pay for. And I'm sure, again, Kelly, you guys can, for your clients, if they do subscribe to mystockoptions.com, which does have tax guides and does have tax information, I'm assuming you guys can somehow make that available to the employees of your client companies on their whatever their portals are, or whichever stock plan system they're using. But there are ways to do it that don't need to cost a lot of money. But I think my advice is always, you can't really, as Don Tobias said, you can't just kind of go, yeah, not my problem. You're the employee, you pay the tax, I'm not going to get involved. Because as you said, these things can turn into dynamite real quick. And
it only takes making a mistake on one person. And that's what I've noticed is people feel because they have a handful, it doesn't get the attention it requires. It's like, it takes one mistake, which is so easy to do. So don't, like you said, bury your head in the sand just because it's only even one person. You have to do this right.
Yeah. Well, I'm going to tell you one story at the end here, and then we'll finish. Back in the 90s, when everyone was moving, all the American companies were moving to Japan, the Japanese tax authorities were looking for, they want to make sure that Japanese employees who were getting stock options to Microsoft and Intel and Sun Microsystems, all these big companies, that they were paying the tax. So the tax authorities drove around Tokyo looking for logos on the outside of buildings, and then they would write them down. And then they would go look, okay, Intel, and they'd send a letter to, the head of Intel, and they'd say, we need to know who all the employees are in Japan and how many stock options they got, because we want to make sure they're paying their taxes. And they did this to all these companies in the Silicon Valley. And they found a lot of employees in Japan were at the time not paying any tax. Like they were exercising their stock options at their Smith Barney or Merrill Lynch, taking the money, leaving it in the United States, not paying tax. And it was interesting. And I always thought, that's a very simple way to go find out, drive around and write down all the logos. So
old school.
Yep. Well, listen, thanks so much. I hope this was helpful for our listeners. I think Don Tobias gave some great information about just a handful of countries, but there's so many more out there. So Kelly, if you don't mind, would you be willing to email everybody with the link to the Baker McKenzie Matrix so everybody has it in case they weren't able to get it here on our webinar? And we'll look forward to talking to everybody next month. And thanks so much. Thanks, Don Tobias.
Thank you. Thanks, everybody. Have a good one. If you're on the East Coast, stay warm.
Yeah. We thank you for joining us today, and we hope you enjoyed the discussion with Don Tobias, Kelly, and Karine. For more information about these speakers, please scan the QR code for their LinkedIn pages or visit us on countsy.com. Please follow us on our LinkedIn page for updates on upcoming webinars, and we look forward to seeing you at our next one. From all of us at Countsy, thank you again, and have a good rest of your day.